Baffled by the bear market?
I told you I ain't a bear.
Roar, roar, roar. No one understands you, she-bear.
You've come to the right place. Hi everyone, I'm Mark Lichtenfeld, Chief Income Strategist for the Oxford Club. Welcome to State of the Market. Last week, I promised to give you a list of stocks to beat back the bear. I'm Mark Lichtenfeld, and I'll see you next week with my list of bear hunting stocks. Well, it is a week later, and I've got the goods. 3 beat-up stocks selling at a discount that would make a fine addition to anyone's portfolio. Before we get into it, make sure you're subscribed so you never miss another video. Just click that big red subscribe button, and you're part of the family.
We accept that one of us. We accept that one of us.
All right, the name of our first stock is something we could all use more of, Better Choice, ticker symbol BTTR. Better Choice is a fancy pet food company that sells holistic doggy kibble and vegan treats under the brand name Halo. I'm not entirely sure what makes dehydrated meat pellets holistic.
He's holistic, George. He's holistic.
But I know that pet owners will do anything for their animals.
God loves a terrier.
Better Choice is a relatively new name in the pet food game with just a $72 million market cap. But its stated mission of empowering pet motherhood is winning over holistic pet moms and giving this microcap some strong holistic growth. In Q1 of 2022, the company's revenue jumped 45% from the previous quarter to $19.7 million. The company also increased its margins despite higher commodity costs and aims to hit $100 million in revenue by 2023. From a holistic perspective, Better Choice has a rock-solid balance sheet with more cash than debt, and management is putting its money where its mouth is. In addition to buying back shares, insiders bought company stock like crazy in May. And as we know, seeing this kind of buyer's enthusiasm within the company can be an excellent predictor of future stock performance. At the very least, those inside the company have reason to expect good things are coming.
What's up, guys?
But for now, the stock is down 19% year to date. It trades for about $2.50 a share, or 17 times last year's earnings. I don't have to tell you that pet moms love their little fur babies.
Hi, I'm Elle Woods, and this is Bruiser Woods, and we're both Gemini vegetarians.
They're going to continue to feed them well regardless of stock market conditions, which makes Better Choice an excellent choice to rebound in this bear market. Okay, my second stock is a whopper of a value stock, sporting goods Hibbett, ticker symbol HIBB.
Crocodiles. Alligators.
Hibbett may sound like an involuntary eruption of a cartoon drunk, but listen to these numbers. All right, are you sitting down? Well, you better stand up and sit down again just to make sure.
I gotta sit down.
Because this stock trades at 4 times earnings, a ridiculous 0.6 times sales, and 2.7 times its book value. Compare that to competitor Dick's, whose name I have zero jokes for, trading at 6 times earnings, 1 time sales, and 4 times book value. Hibbett has weathered the pandemic better than most of its competitors, which may have something to do with the deliberate way they locate their stores. Instead of plonking down stores in every outlet and mall, Hibbett targets locations that minimize competition. According to the company, 70% of its stores have 2 or less competitors within a 15-minute drive, while almost a third of stores have no material competition within a reasonably close driving range. In many places in America, if you need baby baseball cleats or a compression jockstrap, your only options are your local Hibbetts or a store at an unreasonable driving distance.
It's 106 miles to Chicago. We got a full tank of gas, half a pack of cigarettes. It's dark, and we're wearing sunglasses. Hit it.
And yet, this prime value stock has been absolutely smoked by this bear. Hibbett has been cut in half from its November high of more than $101. And it's no secret that recreational stocks take a hit during bear markets, but this company's been around since 1945. This isn't its first bear market, inflationary period, or even, dare I say it, recession. The company is built to last, and at the current price of just over $50 a share, bad news is already baked into the price. Sweetening the deal is a 1.8% dividend, which you know I'm all about. And one last thing before we move on. 19% of the company's float is sold short. That is a very big number, and it means there's potential for a short squeeze as the stock rises. A short squeeze occurs when a stock rises sharply, pushing short sellers to cut their loss and bail out. Now, as they buy stock to cover their position,
I'd like to buy 500 shares of Animotion Incorporated.
They inadvertently create more demand for the stock, pushing it even higher and twisting the screws on remaining short sellers. Even without the prospect of a nice firm squeeze, Hibbett is a hardy value stock to see you through a bear market. All right, today's final company is absolutely fascinating. ExlService Holdings, ticker symbol EXLS, analyzes data for the insurance, logistics, accounting, and other industries. Okay, maybe not fascinating, but it's hard not to be excited about the growth this company is squeezing from all that boring stuff. Over the next 3 years, XL's forecast to grow earnings by an average of 17% annually. Yet somehow analysts don't like it. Only 4 out of 10 analysts rate the stock a buy. Now that's hardly the winning recommendation of 9 out of 10 dentists, but the one thing we know about analysts is that they are achingly slow to react to anything that isn't spoon-fed to them. Now your average Johnny-come-lately waits until a stock has moved higher or lower before they upgrade or downgrade it, which is less analysis and more note-taking. This is most definitely the case for ExlService, which is great news for us. When the analysts finally get their act together and upgrade the stock, it can act as fuel to push it even higher. Meanwhile, the company's 4 largest shareholders, BlackRock, Vanguard, Fidelity, and Macquarie Group, added 1 million shares to their holdings in the first quarter, and JP Morgan scooped up another 250,000. A strong grower that analysts hate and the buy side likes? Sign me up. And that wraps up my 3 stocks to buy for the bear market 2022. And tell me what you think of my picks in the comments section, and click the link in the description for more free wealth and income building ideas with my daily e-letter, Wealthy Retirement. I'm Mark Lichtenfeld. I'll see you next week on State of the Market.